Exchange rate funds have gained tremendous popularity in the world of investing over the past decade, now exceeding $10 trillion in assets under management across the globe held in these financial securities as of 2021. And there is good reason for this, right? As individual stock values rise and fall, as we've seen a ton of over the past couple of years, as higher interest rates have ravaged tech and growth stocks, well, ETFs tend to soften the intensity of these ups and downs because they can hold dozens, often even hundreds or even thousands of individual positions. You can think of these as groups of financial securities that allow investors to buy into a given subset of the market, gain exposure to many positions all at once, and generally charge low management fees compared to alternative securities such as mutual funds. So like every turn of the year on the channel, today we'll be discussing a handful of ETFs that I personally hold in my portfolios right now, but that I also plan on continuing adding to and maintaining for years to come. And thanks to TD Direct Investing for sponsoring today's video, but more on how you can get $300 in cash later on in the video. Rewinding over 5 years ago now, the first ETF that I ever bought was what's now the bread and butter of my portfolio's foundation, which is why it makes an appearance yearly on my channel, even though it's a relatively known index fund at this point. So we're looking here at an S&P 500 index fund, in my case being Vanguard's VFV in my Canadian-based portfolio and Vanguard's VOO in my US-based stock portfolio. Now, the reason why the S&P 500 is a core holding in my stock market portfolio's foundation is simply due to the nature of the positions that are held within it, being the 500 largest and most impactful companies that trade in the American stock market. And historically speaking, the American stock market has created some of the highest global returns over an extended period of time when looked at over several decades, meaning the composition of the S&P 500 is in constant movement. So as an investor in an S&P 500 ETF like the ones I've mentioned, you get the luxury of sitting back and essentially taking advantage of the growth of the American economy across all industries without worrying about rebalancing individual positions in your portfolio. Now, of course, the American economy is currently in a recession, coming hot off the tail ends of the pandemic, and naturally, most all financial securities are feeling these economic impacts, especially an index fund like the S&P 500 that does have a heavier now weighting towards the tech sector. So right now, we're seeing the S&P 500 down roughly 15% from all-time highs after rebounding a bit from 12-month lows. What's great about S&P 500 ETFs, though, is that they can create a low-cost base to a long-term portfolio with generally low expense ratios, while also providing a slight dividend yield to supplement a portfolio's income. Speaking of investing in exchange traded funds this year, I'd like to take a moment to talk about how I've teamed up with TD Direct Investing, which is a self-directed online brokerage that's helped me achieve my constantly evolving investing goals over the years, and how it can help you do the same. Now, it's no secret that investing can often feel a bit overwhelming if you don't have the right tools and resources at your disposal, which is one of the reasons why I've used TD Direct Investing over the years, even as my own investment focuses have varied between individual US and Canadian stocks, and what I focus on the most for long-term investing being low-cost, diversified exchange-traded funds and more. In fact, as I've had evolving goals over the years, like buying a house, buying my first rental property, and also saving towards retirement, even though that's not for a while, TD Direct Investing has been a great resource along the way to support these goals with its range of investment products, extensive research tools built right into the platform, and customizable features to give you insight into the performance of your unique portfolio. So really, no matter what your financial goals are, TD Direct Investing can help you get started and reach those goals, even if that's 10 or 20 years down the line. Finally, if you open a new TD Direct Investing account, you can get $300 or more in cash. This offer ends March 1st, 2023, so why not click the top link down below in this video's description to sign up and get started with TD Direct Investing today. Quite rarely do modern economies outside of the United States create higher returns for investors, which is why most portfolios tend to concentrate their efforts in the American stock market. But as a Canadian myself, I'm also invested in the Canadian stock market through some individual Canadian stocks, but mainly through the XIU ETF, which is the iShares TSX 60 Index. This ETF is actually quite similar to what the S&P 500 represents for the American stock market, but considering the fact that the Canadian stock market is quite a bit smaller, this fund only holds the top 60 companies that trade on the Canadian stock markets. Now, I mentioned that the US market's returns generally reign supreme over other markets, specifically the Canadian market. But according to analysts, in 2023, the Canadian market is actually set to outperform the US equity markets. And this is mainly because the Canadian market isn't nearly as tech heavy as the American market is, which, as we've just seen, higher interest rates negatively impact tech and growth positions. Instead, the Canadian market is more heavily weighted towards the financials, energy, as well as industrial sectors, with around 65% of the XIU ETF being concentrated in those three industries alone. So considering higher interest rate and inflation levels in 2023, the Canadian market could very well outperform the US market. But even regardless of shorter term movements, XIU is an ETF that have held for years and will continue adding to and holding for years to come. In fact, interestingly, the TSX has even outperformed the returns of the S&P 500 in 7 of the last 10 rising interest rate cycles since 1979, which is something to consider. Overall, though, at a management expense ratio of only 0.15% and a 12-month trailing dividend yield of 2.84%, XIU is a strong ETF that I consider a solid part of my portfolio's foundation. If you've been following my channel for a while, then you know that I'm a fan of dividend stocks as well as dividend exchange traded funds for their distributions that create income for my stock market portfolio. And whether or not we're in a recession, if the dividend positions have been chosen strategically, then they should continue paying out either monthly or quarterly distributions, which over time make a huge impact on the compounded growth of your portfolio. Seriously, these smaller dividend payments, even if they seem insignificant in the moment, can turn into hundreds of thousands of dollars of extra portfolio value over the course of an investment career if they are periodically reinvested. Never underestimate the power of small, consistent actions. Now, of course, there are hundreds of different dividend ETFs to choose from, but one that I hold is Vanguard's High Dividend Yield ETF, ticker VYM. What's great about the VYM ETF is that it invests in 440 dividend-focused American positions, excluding REITs, which actually tend to also come with higher than average dividend yields. But unlike with the S&P 500 that invests in a broad variety of different positions across all industries, well, the VYM ETF strictly focuses on positions that have higher than average dividend yields. And this generally tends to be in the financials, industrials, as well as healthcare industries, with leading positions including Johnson & Johnson, Procter & Gamble, as well as JP Morgan. And so this is exactly why the VYM ETF has a 12-month trailing dividend yield of 2.98% with a rock bottom management expense ratio of only 0.06%. Now, this dividend yield isn't necessarily anything groundbreaking, but at nearly 3% across the entire fund, it does offer more dividend stability than most individual dividend stocks will over time, while also smoothing out market value returns for the fund in question. 2022 certainly wasn't the year of the tech stock, with average values across the market shaving anywhere from 15 to even 95% of their value from all-time highs reached during the market euphoria fueled by the pandemic era stimulus. But where does this leave us today, with one of my most heavily purchased ETFs over the past couple of years in the absolute gutter, right up there with my grocery bill? If your portfolio has any exposure to the NASDAQ 100 or any other tech-heavy exchange trade fund, then you'll know exactly what I mean here, with the index down nearly 30% from all-time highs, leading many investors to believe that the era of tech stocks is dead, which for the time being certainly is the reality that we're faced with. We know that tech and most growth stocks tend to react negatively to increasing interest rates, so in the current economic environment, negative tech stock movements are to have been expected. Where things start to change, though, are when we consider the fact that with tech stocks currently depleted already, with higher interest rates having already ravaged the entire market, well, the next couple of years could be interesting for tech investors. Specifically with a NASDAQ 100 ETF such as the QQQ ETF in the US and the HXQ ETF here in Canada. Both of these ETFs track the NASDAQ 100 index, which is why roughly 50% of the index is concentrated in information technology positions, followed with telecommunications and consumer discretionary. Now, the past years represented some of the worst returns for NASDAQ 100 investors since the 2008 recession, but on average, yearly gains for this index are higher than the the S&P 500, as we can see from this chart. This is simply due to the fact that technology stocks tend to command a higher valuations than companies from other industries, and technology is really where the future economic growth of the American market ultimately lies. So even though right now the Nasdaq's in a bloodbath and most investors are running the other way, that doesn't change the fact that the future growth of the American GDP and economy is going to be heavily weighted towards the technology sector and undoubtedly outpace the rest of the American stock market. So considering the fact that the Nasdaq 100 index is down nearly 30% from all-time highs, I'm personally going to continue dollar cost averaging into this position as I have for over 5 years now. Additionally, don't forget to check out TD Direct Investing using the top link down below in the description, and if you do open up an account before March 1st, you can get $300 in cash. So thanks a lot for watching today's video and best of luck with your investing. I'll see you in the next one.